Good morning and welcome to the Monday Call. I'm Stefan Clark, Chief Client Officer at NZ Funds. The world and therefore the market is a complex place to navigate at present. Higher rates with lingering concerns around inflation and geopolitical risks, counterbalanced by a resilient US economy and the attractive growth prospects brought about by AI, combine to make an interesting opportunity set for macro investors. This week, we're joined by James Grigor, partner of Syzygy Investment Advisory in London, and NZ Fund's Monday Call interviewer turned interviewee. Syzygy is an alternative asset management and advisory firm focused on global macroeconomic thematic alpha generation with clients that include sovereign wealth funds, family offices, pensions, and NZ funds. It's great to have you here, James. I'm really excited about today's conversation and very much in a different capacity this time.
Thanks, Stefan, and hello to everyone. Yes, it is quite different. It's in the hot seat now, not getting to ask the difficult questions, but hey, we'll do the best we can. Maybe I can turn it around and ask you a couple of questions as well, and
Hey,
get back
I'm
on
leading the interview.
the.
So you're now based out of London, and you're working with Bill Callahan at Syzygy, and of course continuing to work with NZ Funds. Talk to us a little bit about what your role entails and how you're finding arriving in another country.
Sure. So it's been an interesting transition actually. For those of you that have moved countries, it's a whole lot different the last time I did it, which I was in my late 20s and had no kids, to now a couple of kids and moving the family across. And we started our trip obviously in New Zealand and went through the US to then arrive in the UK. And you do get I guess it's the nature of the job that we do, is you do get a sort of a first-hand feel for how different economies are going and views, especially political views around the world and what's going on. And so, yeah, and I'm sure we'll dig into both of those as we go, Stefan. But it was certainly a interesting transition. What about Syzygy? What do we do? I think if you think about the dynamics of the investment um, in the investment universe and ways to invest, NZ Funds has always been that firm that wants to be curious and invest to reflect the investment environment, not just invest in asset classes because we always have. And that's essentially what Syzygy does too. So we try and seek out alpha generating opportunities, whether they be in commodities, interest rates, shares, bonds, whatever it is. We research those opportunities. We get an understanding of the best way to have them represented in the portfolio, and then we advise clients like NZ Funds on that position throughout its journey. So it's pretty much the same as what we were doing at NZ Funds, except in a different time zone, perhaps an easier time zone, because most of the stuff that we do invest in and the macro exposures in the NZ Funds portfolios are in UK and US time zones. So there's no more 3 a.m. wake ups for CPI and GDP numbers, which is quite nice.
Fantastic. So you mentioned travelling, and take us through where you feel Europe and the UK are at, because obviously New Zealand is still in a recession, according to the data, and the US continues to grow. What's the feeling over there? And feeling's a funny word, but I think it's probably the right word.
I think with all that's going on in the investment world and political world, I think Europe is probably and the UK are probably the jurisdictions that are under the most pressure. I think, and we'll talk about the US later, which is still a resounding success in its economy despite what's going on with interest rates and politics. But in Europe, they really are at the forefront of the slowdown and structural shift in growth in China. If you think of the EU as a whole, they might be growing, albeit in small numbers, but big countries within the EU, like Germany, are already in effectively a recession. And that's because what they're doing, I guess they're getting hit on both fronts. From a US perspective, Europe is importing their high interest rates. Really, when the Federal Reserve increases interest rates, most other countries have to follow. So in New Zealand, we've had an increase in interest rates. Yes, we've got high inflation, but really it's following the US, and a lot of the inflation in New Zealand is caused by US inflation, and that's the same as Europe. The other thing you've got in Europe, though, is their biggest export market, or one of their biggest export markets, is China. and China is massively slowing. So they've got rising interest rates. They've got a big trading partner that's slowing in its growth prospects. And then the third angle to why Europe's really suffering is from this high energy prices caused by not only the events in Ukraine, but what's going on in Ukraine is a big part of it. But a lot of their energy, whether mainly natural gas, but oil as well, comes from Russia, and their reliance on Russia and other countries that perhaps geopolitically aren't flavor of the month at the moment for obvious reasons. And so those three things, higher interest rates, lower growth because of some of their big trading partners, and high energy costs mean it's a real issue in Europe at the moment, and they are bracing themselves for certainly a slowing economy, and much the same in the UK. The UK has the added bonus of a government that's not overly popular, and and the problem with that, whatever your stripes are, if you're in a government that's not popular, but you've still got quite a bit of time until the next election, it's just really hard to get reforms through. And so you can't really make any major changes that really need to be done within the UK economy to get it out of its funk that it's in at the moment.
Righto. And from an investment perspective, that's reflected very much in prices, is my understanding. And so in the European market, valuations are exceptionally good, but you get what you pay for.
I think, Stefan, that's an absolutely outstanding point. I think we have to be really careful with getting gloomy over economic outlooks, and not let that tarnish too much. Obviously, an effect, but not let it tarnish too much our views on the share market. As I've always said and banged on about, and most of you are probably sick of me talking about it, markets are forward looking. If there's anything that you're reading in the newspaper, watching on TV, looking at in terms of data, it's already priced into the market. And it's a very efficient market because of technology and data sources, etc. And so all the aspects why Europe economy is under pressure is already, you could say, effectively priced into the market. Now, how long the pressure goes, so how long do inflation rates stay high in Europe and therefore higher interest rates, and how long does China stay low growth is probably some aspects of that you need to take a view on. But you're right, the European share market is really cheap, and something that provides an interesting opportunity. And I think when fund managers, especially active ones like NZ Funds and Syzygy, talk about this as a stock pickers market, they're not just plugging their own way and own strategy of investing. It certainly is. So Europe as a whole, the economy as a whole, yes, difficult, but there's some really cheap shares out there. And if you can buy the types of shares in the right industry, in the right sector that do well in the current economic environment, you're doing that at a very cheap price, and you're going to do very well despite what's going on in the wider economy. And that's why being an active investor is so, one, important, and two, really exciting, because at times like this, it just provides a huge amount of opportunity for investing.
A lot of the commentary recently has been around inflation, and it seems to be driving markets as a thematic more than obviously because it's been so elevated than it has been for a very long time. In June 22, we had US inflation at 9.1%, and then I think a couple of days ago, the most recent print was at 3.7, which was a little bit higher than what people were expecting, but core inflation was down at 4.2%. What is your read on the direction of inflation in the US, and then what does that mean for share markets like the European share markets, Australia, New Zealand, so forth?
So I think that's really where the entire market is focusing on, is those inflation numbers. So really, if we set up the construct for the rest of the year, that might give us a way to sort of approach and tackle that question, because I think what you're talking about is really important around how we think about investing in shares for the rest of the year and into next year. So the market in the US is currently pricing in no interest rate rise tomorrow or this week. Sorry, it's next week, when the Fed meets on the 18th, 19th of September. So the expectations are there's no increase in interest rates then, but they are the market. So the general market believe that there will be one more interest rate increase in the US before the end of the year, most likely November. And that's premised on those inflation numbers that you've been talking about, and the fact that we're still not down at their target rate. But if you actually dig down into the numbers, the strength of that inflation number we've just had, or slightly higher, very slightly higher than expected, was probably caused by the fact that actually oil prices are stubbornly high, and higher than they were just a couple of months ago. Oil's back at $90 a barrel, which is probably a place that we're likely to see it stay. Saudi Arabia, OPEC want it to be at about $90. That's their quote unquote break even price for oil. They want to do all these other things within their countries to diversify away from oil and to be able to afford all those infrastructure builds. And I think Saudi were talking about turning Saudi into the Europe of the Middle East. It's going to cost a lot of money, and they sort of forecast, and analysts forecast, that $90 oil will get them there, and they can do that with restricting supply. So that's one aspect why inflation was a bit higher, but it's unlikely that oil is going to go much above the region that we saw it might go to during the Ukraine crisis. And so you're not going to get a second order effect of another spike up in oil prices, or dramatic spike up at least. The second thing is inflation. A lot of it is starting, that builds up the inflation number, is starting to tail off. And a big part of that is the cost of rent in the US. Now, those numbers were a huge driver of inflation over the past few years, and that's really starting to come off now. And so rental is starting to come down significantly, and it's a significant, I don't have the exact number off the top of my head, but it is a significant determinant of the inflation number. And I think why it will take some time to come off, but there is reason to believe that it is coming off, is because there is a lag effect. When things get tough, you don't just ring up your tenants and go, hey, we're going to decrease your rent. Unfortunately, that doesn't happen. What normally happens is there's turnover, and it slowly reduces over time. But there is data to suggest that is happening. One aspect of that number that you can look at is the equivalent of Trade Me property in the US, called Zillow. And you're really seeing a decrease in rent across the board in the US from the Zillow number. So that's houses advertised for rent. And so yes, it hasn't happened yet. People need to pay for that and actually take out a lease on these things that are for rent. But it looks like we're heading that direction. So if you've got an inflation number that slightly beat expectations just recently, but probably because of a higher than normal higher oil price, but not necessarily going huge amounts higher, and you've got other aspects of that inflation number really starting to come off, that puts less pressure on the need for interest rate hikes. In fact, and it is certainly our view at Syzygy that we're unlikely to see that interest rate increase by the end of the year. And so, in fact, we actually believe that there will be no more interest rate rises in the US this year. And I think that is a really important catalyst. There might not be a cut in interest rates, but having that pause is the first step towards things just starting to calm down on the interest rate cycle. And really, when you go through to the end of the year with interest rates on hold, you're then going to start seeing some of that lag data come through, whether it's GDP growth, whether it's slower consumer spending. We just had a really high retail sales number in the US, and that was really buoyant. But it appears a lot of that retail spend is being spent through the exhaustion of savings. So a lot of people during COVID saved a lot of money, and they're now they now spending it. And you can see that really starting to slow down now. And the reason you're seeing some of the data that you're seeing starting to slow in terms of retail, and the fact that some of that savings has been exhausted are things like travel. Travel you're starting to see slow down. So these packed planes that you're seeing around the US is starting to lighten up a bit. And so what does all that mean? It means that with interest rates pausing and more likely that the next move is down, that is a really, really positive environment for shares, especially shares that have already been really struggling over the year to date. Not all of them. It depends kind of the sector that you've been in, but on the whole, especially the shares that reflect the economy less, aside from things like Nvidia, you're really seeing those companies at prices that are prices that you happily pay for in an environment where interest rates are going down. At the same time, it's really good for tech companies, high growth, low cash flow shares. In an interest rate environment that is decreasing is really positive for those shares. So that's good for the US. What does it mean for those other markets? Well, as we said at the start, it's really the Fed that leads where interest rates go globally. It means Europe stops importing as much higher interest rates. They then feel less pressure to keep raising interest rates there. And there's also the domino effect down into New Zealand and Australia, where there'll be other aspects why, and we can talk about New Zealand in detail, Stefan, but there'll be other aspects why New Zealand probably is at the end of its interest rate hiking cycle. But you're starting to see that pressure start to release, and that's really good for shares, especially shares that have already been struggling, because it means they're at a better valuation than they were, 6 to 8 months ago.
Yeah.
China's a really difficult one. I think there was an expectation, I certainly had it at the start of the year, that China economy was under pressure, and and the government was going to do a huge amount of stimulus to get it back on track. And and on top of that, shares were pretty cheap in China. They had a terrible 2022, so you had cheap prices and a weakening economy. And as we said, don't um, markets are forward looking, so markets had priced in that weak economy. What they hadn't priced in yet was this big stimulus package that the Chinese government were going to come out and implement, and shares were going to bounce from there. That hasn't happened. In fact, um, they are being very, very, very long term and patient around structurally stimulating the economy. The housing market is a big aspect of that is really causing a lot of grief within the Chinese market and Chinese banks. One statistic which is super interesting is if you think about um, China and demand for housing and uh, how much how much needs to be built that's already been consented, and all those stats that we talk about a bit in New Zealand. In China, there is the equivalent of 50 Manhattans. So it's 50, the island of Manhattan, New York, equivalent of square meters of land that some of these that these property companies own, that haven't been developed yet, but yet they've bought and have ready to develop. And so that is the amount of land that is sitting there, undeveloped, but has loans sitting out on them, that are now worth a lot less than they used to be. So there's a huge amount of undeveloped land in China, um, and really there is no credit or um, way for these companies to get funding to build these properties. And so what you're seeing is properties that have already and build projects that have already been started are being finished. So you are seeing they're called housing finishes in China, doing quite well, but there's no housing starts. This land that's sitting there undeveloped is not being started, and that was a huge driver of the Chinese market and Chinese general economy. And so without those building starts and without the stimulus in the remainder of the economy, you're starting to really struggle to get that growth coming through. And so the biggest aspect or I guess, stress on the Chinese market um, is perhaps not the share market, it's their currency. So the Chinese currency, the yuan, is pegged against the US dollar, and they're really fighting for their lives to keep that currency from depreciating too much against the US dollar. Because if that happens, the more you depreciate, the more expensive things get in terms of trade. And that starts to become really difficult. It's obviously a little bit because then they export things as well, and that's good for their export partners. But China is really under pressure around the economy, the housing market, and then pressure around the currency. And what does that mean for the rest of the world? Well, a slower economy in China does put pressure on, especially Europe, New Zealand, Australia. And the problem with Europe, New Zealand, and Australia, we've still got high inflation. So we've got our biggest trading partner slowing in growth, but we've still got high inflation where interest rates might not be continuing to rise, but they're not being cut anytime soon. It appears, or not in the next few months. US is a bit different though. It is putting pressure on US economy, absolutely, but perhaps they're the least affected by what's going on in China, and their economy still seems really robust.
Okay. It's interesting, right? Because the success that drove China forward is an overarching question of whether that's ended or whether we're just going through a blip. And China's continuous, excuse the pun, long march to building the prosperous nation that it's really trying to do. Do you see growth picking up there, and then we'll be back to the 5% to 7% growth rate that we're used to in China, or do you think this is the beginning of something longer term?
Look, I think the two aspects of views are exactly that. Do they put in huge amounts of stimulus into the economy and get that growth rate back up, or are they happy with the new normal? And this is where I'm not going to at all profess to be a China expert. It's really interesting though. When um, if you're sitting there as President Xi and you want to stay in power essentially forever, you get dispose of your biggest critics. And so you saw that in the last conference where some of the sort of the older guard that used to have quite a bit of power and say within the party was sort of removed. Um, you know not necessarily removed in a bad way, but sort of put out to pasture and sort of forced to retire. And there was that famous um, clip in the conference last year where one of the old guards was sort of escorted out during the meeting. But the other thing that keeps you in power is the people have to be happy. And if the people are happy, then they're less likely to rebel and come against you when things are tough. And so, on one hand, you could imagine that they will want to be stimulating the economy, because if they stimulate the economy, then you get a stronger people and a stronger sense of positivity and optimism, which enables you to continue to hold on to power. Um, the way that President Xi is doing it, though, it appears, and again, this is just sort of views from reading rather than being necessarily an expert, is to, instead of stimulate the economy and get that going and pumping up back up to the 6 or 7% that it used to be at, given the economy is so much larger, to grow at 6 or 7% is truly difficult. The focus is on security and that the sort of China first mentality. So what are some of the things that the government doing to encourage that? There are things like Taiwan and wanting Taiwan to be back part of China, and that sort of show of might and show of power. The other one is around tech companies. And if you think about what's going on, what went on with things like Google and Facebook first, and that brought up companies like WeChat and Tencent and those sorts of companies. So they've got their equivalent fangs in China and they're proud of that, and they're amazing companies. Didi is another one versus Uber, and so it's to create that infrastructure that the US has, but the Chinese equivalents in China. But now they're going a step further in this, um, I guess, government ban on Apple devices and for any government employee, which there are 60 million of, is super interesting because one, you go, well, it's only 60 million people, and in China there's 1.2 billion. But we've got to remember the point that if you woke up tomorrow morning and the UK had just banned Apple, that would be pretty big news, and the Apple share price would probably suffer quite largely from it because it's not just the 60 million. I'm not suggesting that everybody has an iPhone, but let's say 60 million phones. It's also the watches, the laptops, the paying for apps, the services, and the UK has 60 million people. So actually, the banning of these devices for government employees is big news. But where do they stop? And so, what company is next? If they're banning Apple, is the next target Tesla? You know, Tesla is a big, China is a big market, and China is a big market for Tesla. And Tesla have quite a big market share in China. And that is that the next company to face some sort of ban? And then it goes from there. And so we might not see a trade war per se. There's no banning of iPhones into China, but we might see a different targeted approach. And I guess the natural reaction that the US may have is the other way around. And we saw it with Huawei, but we could see it with other devices. And so, yeah, you're starting to see a government that is perhaps knowledgeable enough to know that getting their growth back up to 6 or 7% might not happen. But how else do you make the people proud of 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 their leaders and sort of still happy that they're in charge? Well, it's putting the country first, China first, and that seems to be what's going on. And who knows how that plays out? But it is alarming when, I guess, for New Zealanders, given they're such a big trading partner.
Yeah. The Taiwan story is tricky, right? I mean, who knows where that's going? And obviously, there's a whole Taiwan being the world's largest semiconductor manufacturer has, in addition to all the human elements to it, it has a huge economic risk attached to it. Which brings me to my next question, which is something that you've probably been thinking about during your travels a fair amount, which is AI, and particularly AI and what it means for investors. We've, on the Monday call, we've had opposing views. We've had AI from some quarters as, the value is going to be realized very quickly from an investment perspective. And we're seeing that already as, there's people are, the recent run. And then on the other side, we've had from other people saying the benefits of AI will be felt by people, users very quickly, but the investment benefits, so building companies that are profitable and generating real cash flow from the services and tools that AI and efficiencies that AI can create, 3, 5, 10 years, even longer away. How do you think about that?
This might seem cop out, Stefan, but I kind of think it's both, and I kind of think it's both, and I kind of think no one knows. I think it's pretty brave to come and say, look, this is how it's going to happen.
You guys are
Because
paid to have a view, though, right?
but if you think about what happened with the internet and then the tech boom and bust, and this is something that we've talked about before, is you have I think we did on one of the Monday calls, we sort of said, have you ever heard of the company Pets for You? I think it was. And no, that's what it was. At one of the presentations that Private Wealth put on around the country, and it was a show of hands. Who's heard of the company Pets for You? And I think one person put up their hand, but I think they just heard put up your hand and didn't hear the name of the company. No one really has heard of the company Pets for You unless you're in the market. But it was one of the biggest companies on the Nasdaq just before the tech bust, and they had no revenue, no profit. They had a domain name and an idea, and it sounded pretty good, and it got really big. Now I'm sort of making the story sound better than it was. I'm sure it was slightly better than that to be the biggest company on the Nasdaq, but we don't really have and haven't really heard of it since. But we've all heard of Amazon, and Amazon is now one of the biggest companies in the world and has been really successful. Neither of them invented the internet, that both of them wouldn't have been able to do what they did without it. But you also have companies within the infrastructure of the internet who provide the service who have also got quite big. Microsoft is doing all right. They didn't invent the internet, but they were certainly with their Netscape with their Explorer, Internet Explorer apps and things like that, have benefited very early on and very well from it. And then there's the third and fourth order effects. NZ Funds just released its amazing digital wallet, which I've been really impressed with the functionality. And that's something that hopefully our clients, advisors, and NZ Funds, a firm, will benefit from to efficiently communicate and talk with and assess things with their clients. And so everybody benefits somewhere in the ecosystem. And I think that's how AI is going to work. There'll be some quick winners early on, definitely. I mean, NVIDIA absolutely is doing well because of the chip market, and that chip market is sort of, and I guess, is the first advanced wave of AI and those aspects. Not all AI, but a lot of it is AI driven. I think healthcare is a super interesting aspect with diagnosis. If you can put all these stats and numbers into an AI software program that can then help you with diagnosis, I think that's going to be amazing. But that's probably, like you say, 3 to 5 years out, and there's trials and FDA approvals and all those sorts of things. And there's lots of stuff in between. So I think that in order to keep up with it, it's like any of these new technologies, like cryptocurrencies. You just have to stay on top of it, have to stay curious, and you have to participate as you go. Not, I'm going to wait and see how this pans out, because if you wait and see how this pans out, you've probably missed it. On the other hand, you don't want to jump at everything that has the word AI in it, because you don't want to invest in a pets for you. And so again, the technology is amazing. How it's going to be monetized will be interesting, but it's certainly something that is a positive, can be a positive attribute to the share market and the growth of the share market going forward. It's going to give a lot of. You're a lawyer, aren't you, Stefan?
I was former lawyer, reformed lawyer.
Yeah, all lawyer. The winners of the day are going to be lawyers, because there's going to be regulation galore when it comes to this sort of stuff. And so, but we have to work that all out. I don't think politicians even know what AI stands for yet. So it's going to be a long, slow slog. But I still remember, remember when this is gonna take us way back to sort of our generation. But there was a Simpsons episode where they were talking about the future and talking to each other through this computer where you could see someone's face as well as speak. And there was this ridiculous piece of technology that hadn't been invented yet. And wouldn't that be amazing? Well, all of a sudden it came, and Zoom at one point was one of the biggest companies in the world. So it does happen. It does happen quite fast. And we'll have maybe we're just having our Simpsons moment now, but we'll move on to the technology. Will start coming fast and almost without us recognizing that it is even AI, which is super interesting.
The internet sort of crept up on everyone, and suddenly it is part of. It's like plumbing of everything, of the way we communicate, the way we entertain ourselves, the way we do banking, and it just happened in little bits and bits and bits. But at the beginning, people didn't. There was a lot of people thought it was a fad.
Even crypto was a bit like that. Like there's this talk that crypto just came alive during COVID. Actually, it was 2010 or 2011 where Bitcoin was listed and started, and there was this whole ecosystem of cryptocurrencies, and it took 10 years for it to really come into the mainstream. These things take a while, but you also would have made an outstanding return if you did invest in crypto for the first 5 years. So just no one really knew about it.
Yeah, I read, just touching on your first mover advantage point, I read a little thing last night about how Google was actually the 16th search engine to be created. So they definitely didn't have a first mover advantage when they started. Now it's obviously a mega behemoth, but they saw what the technology was capable of, and they found a way to do it better. So you might have, all the AI companies today that are starting up, and it'll, in the end, the cream floats to the top, and something we can't predict today will come through all the noise. It's just you can't beforehand identify which one it is.
Yeah,
So you got
no
to
one,
be
no one,
there. You got to
no
be
one
there.
uses Alta Vista anymore, and that was the one. That was my one of choice. But
That's right.
but I don't even like AI is just this generic term for the technology, in my view. It's like the internet, and there's going to be so many uses. Um, one I think really super interesting aspect of it, and this is only because I listen to one podcast. If I listen to another one, I'll get another really good anecdote. But it's just the ability to code, and no longer, and this is no disrespect to the quality or the genius that you need as a coder, PhDs and very intelligent people. But the type of coding you can do on AI means you just don't need, um, I guess, apparently I could code using AI, which is just phenomenal because I really don't have a brain to be able to code. And I think those sorts of things are amazing because what does that mean for the workforce? Um, does coding go, how does that whole industry change? Because if you think about Google, a lot of those companies, a big chunk of their workforce are incredibly proficient at coding. And if you can do all that automatically, um, what happens? And Google's not going to just up and fire half their team. They'll transition into something else. They'll transition into some other part of the business. But it's just interesting how the whole workforce will change because of AI. I think that's super interesting. And yeah, but how it happens, yeah, maybe it's for my kids to worry about.
We actually had Michael Hansen from Fisher Investments on the call, who's an AI expert, and he spent quite a bit of time. For those of you who haven't listened, I encourage you to go back and listen to that particular podcast. We had some really fantastic insights. His view on this point on coding and the redundancy of coding as a sort of not so much as a profession, it would shift and evolve to, I guess, like you used to have a shovel and you would do digging, and now you control a digger. So the skill becomes instructing the machine rather than, typing or whatever, or the thinking behind it. So a lot of the education that's required to be a coder is still there. It's just you use it in a different way.
Mm.
Very good. Okay, you touched on crypto. Now, the crypto market's a really interesting one. There haven't been many new tokens over the last year or two, but at the same time, the institutionalization, it's a big word, of the digital asset world has continued. And now there are ETFs being registered in the US. Previously they weren't, and more banks are supporting digital wallet type arrangements to hold crypto, and also financial instruments like futures and so forth. Where do you see that going? Obviously, regulation is part of this too.
Yeah, I think regulation is really important. I think the banks especially want to see a good, strong, stable regulatory environment for them to really get into offering services around cryptocurrency. As for not many tokens being issued recently, I think that's a function of the economic environment because that needs capital. And if you think as an individual, if you're an investor, even if you have $500 to invest, and someone said, do you want to invest in a nice dividend yielding company that's going to be stable in a volatile environment like Contact Energy? Or do you want to invest in this brand new token that could make an enormous contribution to the cryptocurrency market and make a really good return, but it's going to be volatile? In this kind of market, which one would you choose? And I think that's what investors are doing. And so the capital attractiveness, the capital being attracted to new issues is low. But that doesn't mean to say that the environment within the ecosystem of cryptocurrency is dead. If anything, it's given the industry time to take a breather, and to work on things like regulation. And I think that they've actually been really stable. And these types of assets, as we've at NZ Funds, we have talked about for many years, act in two ways. The first way, which is Bitcoin, is a store of value, and it's it's the type of asset that could do incredibly well, when there's changes in interest rates, and like we perhaps going through now, and so a decrease in interest rates would be a very good environment for something like Bitcoin. And then a cryptocurrency like Ethereum, which is more sort of the technology-based investment thesis, is going to do equally as well because of interest rates decreasing, because that just means more capital will come into the market, and there'll be more use cases. So Ethereum is like a platform with lots of different other companies will build upon, and build technology upon, whether it's payments, whether it's giving unique identification numbers to pieces of music or fish in the sea or whatever it is. That's really where Ethereum's use case is. And so I think that the environment going forward is going to be really positive. It's going to continue to be volatile because it's a new asset class, but that's okay because it's only generally for most investors, it's a small part of their portfolio. And then regulation might have very, very short-term negative effects as new regulations are announced, but long-term makes it a really, really strong investment if there is regulation. And I'll give you a really good example and compare it to a really sort of boring asset, and that's something like Chorus. Chorus was going through big regulatory change in 2015. And I know it started in 2015 because it's the year I got back to New Zealand. And Chorus was all, it's an uninvestable company because there's so much regulation. And, the Commerce Commission is really going to intervene and not allow things to happen. But if you took a step back and go, hang on a second, answer yes or no, are we going to use internet in New Zealand? Yes. Do we want really fast internet in New Zealand, given we're a small country in the middle of the South Pacific and we need fast internet to communicate with the outside world? Yes. Is fiber a good piece of technology that's proven? Yes. Well, it doesn't really matter what happens in the process to regulation. Once it's settled, it's the type of asset that you want to buy. And that's kind of how, and now Chorus at that time was trading at about $1, and now it's at, I haven't looked at it, but it's around $8. Maybe it's slightly lower because of markets, but that's pretty good return. And I sort of see the same sort of phenomenon in cryptocurrency, albeit a bit more of a volatile journey. And so I think regulation overall is going to be a good thing. Might be short-term volatile because of regulation, but long-term makes it much more investable. So I think it's still there. I think that and with these interest rates, potentially peaking, it's also another short-term catalyst. And I think that's why people are finding that the time is now to list these ETFs, because list them when when interest rates are where they are, and as interest rates start decreasing, the market environment gets good, and if early investors in the ETF have a good sort of initial experience, that helps the ETF issuers, and they do well. No one's going to invest in an S&P 500 ETF at the start of a bear market. Well, that bear market's finished for crypto, it feels like, in the short term at least. And so, perhaps now's the time to start issuing these ETFs. So that's the view, but it's crypto markets, they change every day. And
but it does feel, I mean, if you step back, I mean, as a as a sort of asset pocket, it is a maturing market. And 10 years ago, or even 5 years ago, people were saying it wouldn't be around in a few years' time. It's all just a bubble. And obviously the other side to the equation was no, it has real value, and it just needs to move along the journey and become more part of the broader financial ecosystem. So it certainly feels like we're further along on that journey.
Yeah, I mean, it's still, despite having a tough sort of couple of months or so, it's still up. Just looking now, 56% year to date, 22% over the year, 300% over 5 years, and it's still up 10,000%. So it's now, forget that long-term performance a little bit, because it's but it is a interesting asset class, and it's a diversifier. I think that's the important thing. When we talk about all these asset classes, it's not because when you allocate capital as a investment manager, it's not that you're sort of looking at one asset class and putting it all in there and hoping it does well and then turning around. This is about trying to generate returns for all market environments, and you need some diversifiers in your portfolio. We've always said that shares are going to be the biggest driver of compounding returns over time, and it's going to form the biggest part of a portfolio at NZ Funds anyway. It will always be the biggest part of your portfolio. If you're a growth investor with a time horizon longer than five years or so. But there are other aspects of the market and other asset classes that you want to invest in, because shares are not going to do that compounding returns day in, day out, and you want some diversifiers, whether that's commodities or cryptocurrency, or diversification within the share portfolio, whether that AI stocks or the boring but stable Contact Energy. So I think that diversification's super important, and it also keeps you up to speed with what's going on. So the crypto market, for example, having knowledge of that really helps with some of your share investing, because you understand where the markets go.
Absolutely. And I think that point you make about, and we've talked about this many times on the call, of course, but that it is shares and in the growth portfolio, and obviously bonds, also on an income portfolio, will always make up the core driver of your of compounding returns. And then the other things are there to as little pockets on the side where you can add value and diversify away some of the risk, but they will never be the main component.
Mm.
Okay. You're working for a macro fund now. What do you think, when you sort of do some crystal ball gazing, are the biggest geopolitical risks and that are on and Syzygy's minds that maybe aren't sort of on other people's minds? What worries you?
I thought we've just been crystal ball gazing for the last 47 minutes. No, I think I think politics concerns me a little bit. I'm not here to say left or right or red or blue or anything like that, but just more the real partisan politics does mean two things. One, it means that you get some extremist views, which means that that provides instability for markets. Um, but it also means that you can't get much done at the core, because we're so always talking about some of these extreme things and terrible things or great things, whatever your view is on the extreme things that are happening. The boring old things that lets you grind away sort of almost get left behind a bit. And a good example perhaps of that, maybe this is getting too opinionated, but in the election in New Zealand at the moment, there's such a focus on certain aspects that things like climate change was being forgotten about. And why do I worry about climate change? I worry about it massively for my kids and for I guess, the future of the planet. But also as an investment manager, it's for some of the companies that we invest in and where we see growth, it's really affected by really extreme weather. Good example is, and maybe again, a bit dear to my heart, but things like ski fields. A little bit of a bumper season in Mount Ruapehu, but it looks like that it's not going to be a long season in New Zealand. And the winter that they've just had in France, there was no skiing for a lot of the French Alps. So things like that, I think, concern me a bit. Not climate change per se, but sort of how we can't get politics to sort of, I guess, be a bit more agreeable around some of those aspects. But then when I think about things specifically, so what are some of the juicy comments, I guess, that that we have? Well, when I think about Trump and some of the, I guess, aspects of the market and the volatility that his presidency caused the first time round, well, in actual fact, there is a lot of thought that he actually didn't truly think he would win the first time. And so it did take 2 to 3 years for Trump and the team to sort of get their act together to start really implementing policy to reflect their views. This time round, they've had the last year in power before they got voted out, and then the last 3-4 years of Biden's presidency to really think about what they would do the day they get into power if they win the election. And so it looks like it's going to be Trump versus Biden. I can't see how that will be any other candidates even close to those two, which astounds me on both sides. But so we've got these two candidates, but if Trump were to get in, he's had much longer time, a lot longer time, to plan out what he's going to do with his team. And I guess partly depending on where you sit on the political spectrum, but for most, I think, most New Zealanders at least, that is concerning. And it's concerning because I guess his biggest principle is becoming more insular as a country. And there are things that will have big effects on trading partners, but also big effects on big aspects of global politics which are happening at the moment. So the first thing that I think would be really worrying is pulling the US support out of Ukraine. The second biggest worry is pulling US support out of Taiwan. And those two aspects, especially Taiwan when it comes to New Zealanders, is of real concern about what are the ramifications of that, and what do other people meaning other countries do, like Japan and South Korea, if that were to happen with Taiwan. So I think that is a real concern. And on the other side, I guess if Biden comes in, and I don't have any evidence of what's going on other than to say that there has been concerns around lapses in memory and cohesion and things, and what happens if Biden isn't the president for the entirety of his 4-year term if he wins the next election, and what does that do to the sort of power of the US and the imbalance of the power, and do other interested or disinterested parties like Russia and China take advantage of that? So that's the geopolitical aspects. In New Zealand, I think, if I come back to sort of more my domain, which is the investment markets, I think New Zealand, and it's quite good in some ways being a little bit distant for the past couple of months, because you reflect on it perhaps with a bit less personal anecdote, is really this housing market needs to stabilize. And that housing market stabilizing, and then the consumer getting used to, on the most part, much higher interest rates, and combined with inflation needs to really come down, because those people that are paying high interest rates on their mortgages, and those people that are paying much higher costs of living expenses, means the economy will slow, and that does it tough for especially the more vulnerable parts of the country. And I think that just creates more social I guess volatility, which is always hard to comprehend when people are struggling out there. So I think those are the biggest worries. And what does it do for financial markets? It just creates instability, and with instability creates markets that are not confident. Companies are less likely to want to invest and spend capex, and that means the economy does truck along.
Chug.
A little bit chug along, chug
Chug
along,
along. Yeah.
a little bit slower than usual. And so I guess those are the main concerns. But again, looking from afar, looking at New Zealand and looking at where the fight is in politics, I guess the positive aspect, given I'm sitting in a country, the UK at the moment, which politics are just absolute crackers in terms of what's going on. They've had 5 prime ministers in not too many years, and it's almost worse than Australia, I think, which had a pretty bad reputation. Yes, there's a lot of arguments and disagreements between the two main political parties in New Zealand, but they're pretty close, really, in the scheme of things. And maybe that's a construct of MMP. Maybe MMP that Jim Bolger put in place as a referendum by accident all the way back then actually has created a more stable political environment, and so that can only be a good thing. even if Winston Peters gets back in.
Yeah. Well, I mean, one way to look at it is, that's the role of an investment manager when you're thinking about portfolios, is one to position assets in a way that are really well structured for the current environment and to identify as an active manager. So if you think about NZ Funds as New Zealand share exposures, they're very, and we talked about this a couple of weeks ago with Mark Brooks and Casey Kuiper on who are in parts of our investment team. The setup is for strong cash flow generating businesses with big client bases who are able to pass on costs. Your Contact Energies, your Meridians, your Choruses, your Ryman Healthcares, your Sparks, your Telstras. So they are really well placed to weather any kind of political turmoil for the short term, and obviously over the long run, they are there to generate compounding returns. So as that, as the any instability that comes through the sort of the political process flows through, as an active manager, we're very careful about where, the funds are positioned. But over the long run, elections don't really make a big difference, do they? Especially when you have a red and a blue party that are so similar.
I think that's absolutely right. And look, we can wax lyrical around politics for the next 3 hours. And it's interesting, don't get me wrong, I love politics, I like reading about it, like talking about it. But from an investment management point of view, you just have to forget about it because, yes, there's going to be some politics and policies that are going to affect share prices and bond prices in the very short term. But in the long term, the way that NZ Funds researches companies is, do these companies have inherent value now, and are they going to be worth more in the future? And no matter what the politics are, things like a retirement village that is trading at below book value is going to be worth a lot more in 10 years' time than it is now. Companies like Chorus and, like you say, Telstra, Meridian Energy, who has big hydro power stations, they are all going to have inherent values that are going to increase over time. And that's really exciting. And the environment is almost irrelevant. And like I said, there's going to be Sky City Casino, which isn't in the portfolios because of ESG, but that's a good example of a very short-term headwind because of regulatory change. And actually, it's not the type of business you want to be in because it might not exist in 5 years' time. There is a real possibility that things like casinos are outlawed in some way in New Zealand or Australia. And maybe it doesn't happen, but there's a possibility. I don't think there's any possibility whatsoever that a hydroelectric power station is outlawed in New Zealand and provides nothing but a great form of clean green energy for New Zealand households for years to come. And that's kind of how that's in the blood of an NZ Funds analyst. That's what I learned all the way back in 2001 or something, or 2000 when I started. That's what Casey, who's been there for a couple of years, has been taught. That's what Mark's been doing for 30 years, and it's kind of in the blood of an analyst, and what politics means for it is kind of irrelevant, albeit, like we say, it's interesting and it's fun, and listening to the debates is rather them than us.
Yeah, who knows why you get into it. Okay, hey, James, I'm conscious it's late where you are. Thank you so much for your time. It's really neat to speak with you and see that you're all set up in London. And we'll no doubt be in touch in the near future.
Sounds great, Stefan. Looking forward to doing this all again soon.
Great.
Thanks, everyone. Have a great week.